would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. It's a brand spanking new week. I hope all of you are ready to jump in and just make it all happen for yourselves this week. I tell you, I got to admit, I had no idea, in that process where you want to get the house that you're trying to sell into the best possible condition for sale. When you're trying to do that, and all you have are your weekends, and after your daily chores of whatever they may be, whether you've got a regular 9-to-5 job or whatever, man, it is proving difficult. So pretty much all the painting, all the minor painting is done, sadly. Toying with the idea of actually hiring a painter to come in and do some of the more bulk painting I need to get done. But I do need to get this thing in the market. For those of you who don't know what I'm talking about, I always assume everyone has heard everything I've ever said over the last, good Lord, since 2007, every word I'm assuming everyone's heard. And of course you haven't. Some of you are listening to me for the very first time. What am I talking about? I am taking my own advice that I've given in previous shows, and I'm getting my home ready to sell, and I am strategizing what to do with that. I happen to own a house that is worth quite a bit more than I currently owe on it. We may actually want to talk about strategies that I've been having some interesting conversations with some investors who have made some other suggestions to me that may be worth doing, and we can talk about them here. But the point is to be able to get your home in a shape that gives you the top dollar. Ran into some problems in terms of I really wanted to remodel the kitchen with new everything, and found that for reasons relating to permits versus no permits and being forced to be brought up to codes that are new, for instance, things that might indicate distance between cabinets and other types of stuff, which might limit my ability to reproduce the footprint of my current kitchen and get the process permitted. In any event, so I took a next step and refaced the cabinets that are there, which doesn't require a permit. Looks fantastic. I've posted some pictures of that up on Pinterest. I've been painting various interiors to have it make more sense in terms of the overall look. What else? Just did a huge effort to get the master bedroom ready for painting. It is one of those rooms that desperately needed painting, and there's 2 other areas that need painting. So I'm going through the process of getting this thing ready, and for those of you, again, who are new, this was all supposed to be done about a month ago. The contractor that I was sort of relying on for a huge chunk of this stuff is a family member, and unfortunately is still stuck doing my mother's place. So it's put a big delay on things, but I'm the good news is property values have gone up, and you're going to find one of the most odd things. So I'm getting emails from Zillow telling me that my zip code is a buyer's market. And in the same day, I get a email from Zillow telling me that my home is worth $6,000 more this month than it was last month, and it's projected to improve or increase something like 4% over the next year, which seems like an odd contradiction, right? If you're in one of those situations where it's a buyer's market, you'd think that properties would not be continuing to increase in price. I think what they're talking about is the general availability of properties is perhaps all I can think of. But I wanted to bring everyone up to date because I'm toying now with not doing some things just because I'm concerned about just the volume of buyers that'll be out there versus the volume of properties that'll be out there. We'll see how it goes and the timing of everything. I'd love to get sold sooner rather than later, but it would mean I'd have to go without some of the upgrades in the master bathroom that I was going to shoot for. But we'll see. Well, I might go ahead and do it, market it for a month and see what kind of attention I get. And if it just doesn't happen, that should be plenty of time for my family member to be done with my mom's house. And then maybe we get it all done and go back on the market. Okay. Just wanted to give you a brief update there. No huge updates other than every spare minute that I have is spent getting this place ready. In fact, just before I started doing the show, I told my sons that their bedrooms needed to be presentable for me to view the property with clients. And I could hear the vacuum running up there. And it's rare for me to hear the vacuum running in my children's room. So that was comforting. A couple other things, as I've mentioned, I also keep very plugged into new construction. And about 2 months ago, I reported that there was an excellent sign because the vast majority of properties that were being advertised as brand new were reasonably priced. They were at or below the average for the communities that they were in. And that was great news. And I thought that it was a perhaps indicator of a trend. Well, sadly, in the most recent email I've gotten relating to homes available for sale, the grand opening of Esperanza in Morgan Hill. There's 2 homes. Cheapest home you can get is $1,381,410. And the most expensive one you can get of the 2 is $1,466,000. So both over $1.3 million, rounding up $1.4 million. Grand opening at Solera Ranch. 4 new homes. Now, these ones are more in the average price, but they're not single-family residential homes. I guess we can weigh in your mind how important that is, but these are the most reasonably priced homes in the results. The rest of every single other home is $1 million or more that's currently on the market. So out of the, 4, 5, 6, 11, 19, there are 27 new homes available as of the most recent email I got. 4 of those will be priced between $669,000 and $759,000. Those are smaller homes. Those are condos, condo style. They're built kind of like townhomes, but they're organized as condominiums. Every other property is more than $1 million. In fact, the vast majority of them are in the range from $1 million to $1.4 million. So totally not a continuation of the trend we were hoping was happening, at least in my local markets, right? This is all, my area, San Jose, Morgan Hill, Gilroy, not really jumping into the more affordable range. And we continue to see prices going up. We're also seeing the number of homes being sold dropping, but there really is no relief for folks who are trying to buy something reasonably priced. Interesting thing to note, though, is because remember, 2 ways you can get yourself a home and 2 ways you as a real estate investor can provide that valuable service to folks out in the world, right? If you're a real estate investor, you're still selling a product. You're either rehabbing a home or remodeling a home and flipping it, making it more attractive, more livable, more appropriate for modern living. Whatever you're doing to it, you're flipping it and gaining a profit from that, or you're buying and holding and you're renting. So it's all about what's going on in terms of demand. And there's an interesting article that came out. What day did that come out? Let's see. June 2nd is when this article came out. Headlines: rent in top 10 most expensive cities cooling off. So we need to define what cooling off means. It simply means a reduction in the rate of growth in these things. So still seeing rental growth, but I wanted to get into this because it's things like this that all of us need to take into account when we're trying to figure out our investment strategy. If you're someone who goes one way or the other, if you're someone who is willing to go for the rehab or go for the hold or the rent, the buy and hold for renting, and then perhaps change strategies depending on market values or if something appreciates to a certain point where You can pull out a ton of equity that you can then invest into some other marketplace that might yield you more money per year. Those types of decisions. This is the kind of thing you need to see coming. Eventually, rents will go down, just like everything else, right? We've seen, and if you're someone who is hardcore into wanting to hold the property, you like renting, you prefer it, you don't like doing rehabs, then it's important for you to be aware of things like this because you need to plan ahead for a potential impact on your rent. Now, if you're someone who is in growth mode, where in order for your investment to make sense in your current property, you need a certain level of growth, and you've been anticipating, 1% per year or whatever, you need to be aware that that may not be sustainable, particularly if it's something you need to do over the longer term. Now, according to this article from Housing Wire, monthly rent prices increased just 0.3% in May to $1,316, the lowest annual growth rate in more than 3 years. And that's from, they're quoting a blog post from a website called Rent Cafe. 6 of the top 10 most expensive rental markets had average rents dropping year over year. This cooling down is becoming a new trend, such as in San Francisco, quote, which holds the top rent decrease for the 4th consecutive month. Now, again, for those of you who've been listening for a while, you know that this is something I was actually warning you about. We were talking about this last year when we were seeing so much construction going on that was apartments, that was multifamily units. So what does that equal? That equals a higher level of competition out in the world for rental dollars. So a year ago, I was suggesting that investors who do the hold and rent strategy start considering understanding that your rents are not going to continue to grow at the rate they're growing. The bottom line is folks are going to vote with their checkbook. And when the rent can be substantially reduced by moving into an apartment, the argument was that they'll go ahead and do that, or at least enough of them will, that it will hit you. Let's see. Here are the top 10 most expensive rental markets with the average monthly rent payment in each market and the percentage change from last year. And some of these saw some pretty substantial drops. Now, San Jose, California, $2,579 is the average monthly rent, and it decreased 0.2% annually. Number 9, again, and these are all right in my backyard, these the ones that round out the bottom of the list. Number 9, Santa Clara, California, $2,650, increased 0.4% annually. Sunnyvale, California. All of these are right next door to each other. All of these border each other. Sunnyvale, California, $2,680, decreased 2% annually. Now, here's an interesting one because we've talked about New York. Brooklyn, New York, $2,718 remained flat from last year. So the rent that was being paid last year for your typical place in Brooklyn is the same rent that's being paid this year. Number 6, Jersey City, New Jersey. Average rent, $2,794. That's an increase of 1.7% annually. Now, we're going to go ahead and round out the top 5 on this list after the break, so don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We are rounding out an interesting list because it's that first sign that rental rates are starting to soften. I think a huge reason for this in a lot of these different communities is simply the huge number of apartments that have been built over the last year and a half. I know in South San Jose that's been a huge thing. I know in Sunnyvale that's been a huge thing. I'm not so sure about Santa Clara, and that may be one reason why Santa Clara actually saw a net increase, simply because I don't think as many housing units were added to Santa Clara as these other communities. The one we left off with was Jersey City in New Jersey, which was number 6 on the list. And we wanted to round out the rest of the list after the break. So here we are with number 5, Cambridge, Massachusetts. $2,947 is the average rent, and it decreased by 1.7% annually. San Mateo, California. $3,019 a month is the average rent. That remained flat from last year. Now, and if we go back and look at these, what's interesting is some of the more expensive ones are the ones that are seeing decreases, with the exception of Santa Clara. San Jose decreased despite the fact it was the cheapest one in that Bay Area chunk of land. And San Mateo was flat at over $3,000 a month. Number 3 on the list, Boston, Massachusetts, $3,170 a month, decreased 1.1% annually. San Francisco, California. Now remember, I love talking about San Francisco because it is, when everyone talks about hot markets, San Francisco always comes up. And that is something we have debunked here big time. For all the money you're spending, you are making less on a percentage basis than tons of other communities. In fact, not only are you making less, you're in the 10 worst performing markets in terms of return on investment given current costs. You'd be much better off in one of the other communities that we've talked about in previous shows. Number 2 on the list, San Francisco, California. $3,369 is the average rent, decreased 3.3% annually. That's the largest on the list in terms of decrease. And I think it's well deserved. I think that everything is bloated in San Francisco, whether you're talking about purchase prices or rents. And what's interesting is I don't think that had statistically what's interesting about San Francisco is I don't think that many apartments were added that would account for that amount of a decrease. Now, some of you might remember that way back in March, we covered rents in San Francisco. And at that time, a study from a site called Zumper was saying that San Francisco's drop in rents was actually 9% from 2016 to 2017. So no matter how you slice it, the market for rentals is softening at a time when prices are going up. Now, one good thing for San Francisco is, while I don't think that a level of decrease we've seen can be fully explained by the increase in rental units, San Francisco does seem dedicated to the proposition of allowing construction to occur to create more rental units. So even if we don't want to have a discussion about why it's going down, I think there's probably more reasons. I think there's probably just a fatigue. There is a willingness on the parts of folks who live there and pay these rents to move out of the city to get better rates. When you have areas like Sunnyvale, San Jose, seeing decreases in the rent there, and still, so you can still save quite a bit of more money even over the current average in San Francisco. You just get people moving out, which just boosts availability in San Francisco, which further reduces those costs. I think that's just natural for this to be happening, just based on how expensive it is. So I think it's a mix. I think it's fatigue on the part of the rental population within San Francisco. Then I also think it's the market creating more rental units that's also feeding this. For my money, rents need to go down quite a bit more in order for San Francisco to be appropriately priced. But we'll see how this goes. Again, these are things that you're going to want to take a look at. If you own residential or investment property in these cities, I think these are important things for you to consider in terms of what you are going to do next relating to your investment. All right, so that takes care of San Francisco. Now, the tippy top of the list, Manhattan, New York, number 1 on our list. And remember, this is a list of the top 10 most expensive markets that saw with their rents cooling off in terms of level of growth, and some of them actually had decreases. So Manhattan, New York, and we've talked about New York before. New York has already experienced a drop in terms of its real estate market. We covered that a couple of months back. Average rental price $4,094 a month. That is just unconscionable. It's decreased 2.9% annually, but of course still isn't hitting the San Francisco peak. So these are all areas where markets that we've been talking about for a while that have been very clearly been bloated. Things are finally starting to sort of get back in sync, I think, with reality. And it's going to be a matter of time before these turn around. But these still remain, I think, not great places to consider investing your money. I think you can get a much better rate of return. Now, if you can go in there and do some of the things we've talked about in the past, right? Go to areas that aren't as hot and spot those and spot the trends. We've talked about, early warnings of gentrification, those kinds of things that'll cause currently depressed areas to become the next boom town. Of course, those all stand independent, but in terms of general investment strategies, there are areas where you're seeing far better growth that I think make a lot more sense to look at than these banner cities that everyone wants to talk about. Whenever someone in the real estate industry wants to talk headlines about amazing real estate markets, these are the ones they seem to want to talk about. But I think if you're looking, and remember, this is just a math equation. If you take $1 million, and I know I've said this before, but if you take $1 million and invest it in San Francisco and manage to find one place you can buy for $1 million, unless you put a lot of money in, you're not going to be positive cash flow. If you do a conventional purchase, you're probably not going to be positive cash flow. You take that, and what was it? The last numbers that we saw for San Francisco in terms of rate of return for investments for folks who'd bought real estate in San Francisco a year ago, was it 2% or was it 1.8? It was a really ridiculously small number. And then we compared, and that was at the bottom of the list. It was the second or third worst return on investment in the entire country when measuring metro areas. And then we talked about the top 10, and those were, depending on whose list you want to buy into, we had numbers over 15%, 15 to 20% on some of these communities. Making 15 to 20% on $1 million worth of real estate versus 2 or 3% is huge. And you're diversifying. You're creating a more robust portfolio by having multiple properties that you own that add up to $1 million versus having it all into one, where if your $1 million property empties and you have to get new tenants, you're making $0 while that's happening versus making some amount of dollars when one of the 5 or 6 you've purchased with $1 million in other places, just one is just going to reduce a little bit of your monthly cash flow, not all of it. So anyway, I think having something like that in terms of planning your investment is a far more robust and stable. And for those of you who are averse to risk, right? This is a conversation I've had with a variety of folks where, a lot of people just see real estate investing as a risky period. And I don't really think that's necessarily true. It can be a little stressful, all right? Because we're talking usually about big commitments, financial and otherwise. But it really is math. And unless some apocalyptic thing occurs, and in that case, the last thing you're going to be worrying about is your real estate. If something absolutely horrible happens, there's going to be a lot of other crazy stuff going on. Something like this that lets you diversify things out a little bit just makes you that much more likely to survive bad times. And on that note, I wanted to do full circle and sort of relay you the conversation I've had with a couple of different investors over the last 3 or 4 days relating to what's the smart move in terms of investing. And this isn't something I had really thought of. Last time we talked about this, I was going to sell my home, and I was looking at purchasing another property for myself to live in where I would really increase my cash flow per month, which sounded great to me because I would then be able to save at a rate that would allow me to pretty aggressively invest over time. And I got a couple. I had a one thing I love about this show is I occasionally will get folks reaching out to me who have been doing this forever, and this is they've been doing it for maybe they're in their 30s or 40s now, but they've been doing it since they were in their 20s. And and will expose me to different ideas. And one of them is don't buy anything. Take all that cash that I'm going to get out of this property. And really, it was almost a follow your own advice, dumb guy kind of conversation I had with this person, where they said, you've already spelled it out. You've suggested people not buy in San Francisco for that $1 million and instead buy something elsewhere. Well, and you've been using the number $1 million, but let's say you walk away from that house with $500,000. So why not buy 2 or 3 places in other communities that are going to give you better return on investment and then rent in the community you're in? And, I have to admit, that kind of makes sense. So that's the new math I'm doing. I've been running some numbers and looking at different communities, and there's a couple of different upsides. One, again, I'd have a diversified portfolio. I'd have positive cash flow properties immediately. And 2, imagine the fun road trip that could be. Me getting a place, me going out to the communities I've talked about that I think are good and investing in them, and maybe doing several in different locations. So I'm really doing that diversification that I've talked so much about and suggested that you do. So anyway, I'm still not decided yet on that. We'll see. It sure does. It's kind of an enticing thought, right? All right, folks, welcome to the new week. I certainly hope that you had a great weekend. I truly appreciate you spending your valuable time with me, and I sure hope that you have considered it time well spent today. Thanks again for listening. I'll talk to y'all next time.